just gonna.
I should be okay. All right. In that case, I'm going to share my screen in a second. Here we go. All right. Let's give this a go then. Share screen. Okay. And that should work, Claire. So if you can just give me some feedback that my screen is up. Is that a yes?
Yep.
Yeah, I can see something. Yep.
Okay. Can see it moving? Yeah. Let's get it on the right page. That usually helps. Here we go. Okay. You can see that brief case study?
Yep.
Okay, perfect. Okay. So I'm going to talk you through a very brief case study of a project which I've just completed to kind of put into context the benefit of tax planning, because people like myself can sit in a Zoom meeting and talk for a couple to 3 hours talking about tax and kind of goes over everybody's head. So I'm hoping this particular presentation, which is pretty short really, but it's going to last no more than 10 minutes, because I'd rather spend the rest of the time, as agreed with Claire, focusing on any specific questions that you have based on your own situational scenario, or any things that you're thinking of doing and you've got questions around that. But I thought this would be pretty helpful just as a starting point. So just a bit about me. I'm a qualified chartered accountant. I've had my own business since 2003. So I've been at this for the best part of 18, 19 years now. As a firm and even personally, I specialize in property tax, and the majority of our clients are property investors, and even those who don't invest in property full-time have morphed into investing in property as a secondary income. So pretty much, I'd say 95% of our clients invest in property, even though some of them may not do it full-time. Been recognized for a number of awards, helping businesses, business owners, that type of stuff. I used to go up and down the country doing talks. I don't do that anymore because nobody goes up and down the country nowadays. It's all Zoom talks. I've written a few books on entrepreneurship and one on property tax, which are all available on Amazon. And I run 5 different businesses. That's the boring stuff out the way. So with tax, as you'll probably know, if you've been in business or an employee even, or a property investor, that tax changes every single year, and it's imperative and important that you kind of stay on top of and ahead of the game, because if you don't, it can be really costly. And I've got loads of horror stories which I don't intend to share with you today, but something which you ought to know. And this slide is a little bit out of date, but we've got one of the most complicated tax systems in the country, in the world, and our tax code, which is basically the tax legislation, spreads more than 20,000 pages. So there's a lot in there. There's good news for you and there's bad news for you in terms of that, because in that tax code, there are lots of different opportunities for you to plan to become tax efficient. So there's loads of different exemptions, reliefs, allowances that people don't know about. Now, unfortunately, if you don't use certain reliefs and allowances in the year, then you lose them. So it's very important that those are brought to your attention, or you're aware of those in that particular tax year. So by way of example, everybody has a personal allowance every single year. That's the amount of money that they can earn tax-free. If they don't use that particular allowance, they can't carry that forward to the following year. And that's just a very basic example. There's many other allowances available which you ought to be thinking about using, because if you don't use them, as I said, you lose them. And quite often people say, oh yes, you've shared all these different things about tax, but do they really apply to me? Will I ever use them? Can I use them? Are they simple? Are they straightforward? That type of stuff. So let's jump into this particular case study, which is a project that I've just completed. So this is the building. Excuse my poor photography skills. And this is about a 30-second walk from my office. So if I come out of my office, look right, and this building is there. and it's called the New England Club. It was previously a kind of a working men's club, working people's club, call it what you like. So this is the actual building. On the left-hand side, you can see where it says number 336. That's an existing 2-bedroom bungalow. On the right-hand side, where you can see where it says New England Club, that was the club. And then the area sketched in red is what we had to use for parking. Right opposite where I took the photo is a public space, so it's a park, and right opposite this building, you can, I hope you can see on this particular slide, there's some on-street parking. Now, nobody uses that on-street parking, but the council did not allow us to use that car parking space for our development. So because we converted it into 12 flats, we had to provide enough parking space on site. That meant we were unable to get more units on site, but even 12 is pretty good going overall. So just a bit of brief background history for you. We purchased this particular development as a partnership. We paid cash for the building, and I'll go into the numbers in a minute. We weren't able to use permitted development, so we had to apply for full planning permission. We funded the refurb or the redevelopment or development through a private lender, and the intention is to hold and rent out all the units. We paid £500,000 when we bought it. The planning, legals, all of that stuff cost us £65,000. The refurb cost us £500,000, just under, but I've just rounded the figures up. The interest that we're having to pay on borrowing the £500,000 is just over £50,000. So in total, it's costing us just over £1.1 million. The GDV, as I calculated when I did these slides a while back, I thought would be 1.42 million, and that excludes the 2-bedroom bungalow, which was already on there. Now, including the 2-bedroom bungalow, this building was valued about, I think, 6 weeks ago or 2 months ago at 1.65 million. Now, the bungalow isn't worth best part of 230 odd thousand pounds. The bungalow is worth about 140,000. So although on this particular slide I've put the profit down as 302,000, it's more like 385, 90,000 pounds. So I've exceeded what I expected up front. Let's now look at some of the possible things. And obviously, as you'll appreciate, it's not possible for me to cover every single thing, but I'll cover some of the things you may come across. Now, if you're buying a commercial property, you may have to pay VAT on it, and that's called an option to tax. Now, simply speaking, what usually happens is, especially with older buildings like the one that we bought here, which is the New England Club, somebody at some stage decides that they want to refurbish the building, and it's costing them quite a bit of money, and they want to claim back the VAT on the refurb cost. And HMRC, being kind and generous as they are, will say you can claim back the VAT, but there's 2 things that you have to do in return. One is charge VAT on the rent as you go, and the second is when you sell the building, you have to charge VAT on the sale proceeds. Now, if that happens and you're buying a commercial property, you've got one of 3 options. The first one is obviously to pay over the VAT. That obviously causes an immediate challenge for you, which is you need to fund the VAT. So if you're going to a third-party funder or a bank, most high street banks will fund the VAT for you from anywhere from 3 to 6 months. Some won't, which therefore means you need to find the extra cash. And the second challenge with that is when you're buying a property, if you're paying VAT on it, then you have to pay stamp duty, land tax on the total price. So on this particular building, had we have paid VAT, we'd have paid SDLT on £600,000, not £500,000. So you're paying VAT, and then you're paying stamp duty, land tax on the VAT, which is obviously extra cash going out. On this particular deal, we were able to do a transfer going concern because the person or the entity we were buying the property from wanted to rent the building from us for 3 months. So they were going to remain as the tenant, and therefore we were able to persuade HMRC that this is a transfer going concern, which meant we didn't have to pay the VAT on the purchase. Your other option is, if you're looking to do a commercial conversion, which is basically convert commercial property into residential, then you can file a VAT 1614D to the person you're buying from, i.e. the seller. And if they accept it, then you don't have to pay over the VAT. The benefits are, as I've said, you won't have to find the extra VAT element. You won't have to pay the stamp duty, land tax. And if you're obviously borrowing the money, you may have to pay some form of arrangement fee and interest on the funds borrowed. And sometimes it could take you more than 3 months to get the money back from HMRC. So you may have to borrow it for longer than you initially intended. So that's that bit there. The second thing which you ought to be looking out for, and this is an actual screenshot of the actual capital allowances claimed on this particular building, is when you're buying commercial property, look out for an opportunity to claim capital allowances. Now, sometimes it may not be possible because the person you're buying from has claimed all the capital allowances, but it's well worth doing that investigation when you're buying the building. So I'm not too sure if we have any solicitors on this particular meeting, but it's always prompt your solicitor to ask that question. So when they're carrying out the standard commercial property search inquiries, there's a question on that about capital allowances. Make sure that they check so that you don't miss out. So we were able to claim just over £126,000 of capital allowances on this particular building. And we, as you know from an earlier slide, we paid £500,000 for it. So it's just over 25% of the value of the building because there was quite a bit of stuff in there. So it's well worth looking at capital allowances. Now, when we bought the property, after a while, we figured out it had asbestos, and we had the asbestos removed. If that happens, or you've got other forms of contamination, you can claim land remediation relief if you are claiming through a limited company, which we were able to do. So £14,250 came back to us through claiming land remediation relief. Now, the second one, which is business rates, which is also a tax. What we did was we were approached by a local charity who work with homeless people, and they were looking for premises. Their challenge was they had no money to pay rent. So we did a deal with them where we said, you can use the property and we'll gift you use of the property. We've applied for planning permission, but we'll obviously need to take the property back from you in about 8 or 9 months' time. Until then, you can use the property rent-free, but you'll have to take responsibility for the business rates. Now, charities don't pay business rates or don't pay 80% of business rates. The other 20%, they can get an exemption from the local authority if they make a case for that. This particular charity was able to do that. We then basically saved £10,600 in business rates. The third one, which can be fairly complex, I'm just going to keep it very simple. We bought it as a partnership, obtained planning permission for 12 flats, 6 one-bedroom flats, 6 two-bedroom flats. We then incorporated, so we moved that particular business into a limited company, and there was an uplift in value from £500,000 to £650,000 purely because we had obtained planning permission. So there's an uplift in value. I think we were quite conservative with the uplift, and when the property moved into the limited company, the new base cost, and we'll keep it simple for our purposes here, we'll just call it the new purchase price, was £650,000 and not £500,000. So if we sell those units, our cost would be £650 and not £500. So we're going to save the tax on that additional £150,000, and that equates to £28,500. the actual physical cash saving on the capital allowances is just under £24,000. So, and you've seen a breakdown of that earlier on in the slides. The saving on the stamp duty, land tax, the interest, the fees, all of that put together, because of the VAT, is £7,500. And then this was something extra that we got, which isn't a tax saving, obviously, is the existing, or the seller wanted to stay in the premises for 3 months simply because they had nowhere to store all of their equipment. So they had, I think, 3 or 4 snooker tables and loads of the fruit machines and that kind of stuff. And they said, can we leave all this here for 3 months while we sell it off? So we allowed them to stay in there at a reduced rent of £7,500. So that brought in extra cash for us. When we refurbished, we had to pay VAT on the refurb. So because we contracted out the entire job, both in terms of materials and labor, we paid 5% VAT on that, and we were able to claim that back, which I won't go into because it's quite long and detailed, but there is a way of doing that, even if you're holding on to the units. So the total kind of cash or additional cash in our pocket equates to £112,314. And just so you know, the incorporation, we've not had that cash saving right now because we've not sold the properties, but were we to sell them, we would obviously get that cash saving, and it could be bigger because corporation tax is going up. So as that increases from 19% to a higher figure, that saving is going to be bigger. But this is the actual saving that we have made and can make, including the incorporation. Now, 112,000 is pretty significant if you look at the initial profit that I thought we were going to make, which was £302,500, which is a 37.12% uplift, which is pretty significant for any investor, small or large. So you can see the big benefit of just, and again, all this stuff that I'm sharing with you, none of it is risky, none of it is aggressive. It's just plain, simple tax reliefs and allowances available to any person, as long as obviously you meet the criteria and you qualify. One step further, as you'll recall from an earlier slide about the background, had we left the properties in our personal names as a partnership, and let's just assume that the partners are high rate taxpayers, i.e. they pay 40% on the £302,400 profit, paying 40% tax as high rate taxpayers, we'd pay just under £121,000 in tax, which would then leave us net £181,440 to either reinvest in a future project, or we can take that cash and do what we like with it. And because we moved it into a limited company, if we then sell on the £202,000, we'd pay corporation tax, which is much lower than income tax, depending on your personal situation. For us, we're all 40 or 45% taxpayers, so the figure could be higher. However, right now in a company, you'd pay 19% corporation tax, which equates to just over £57,000. So you can see the difference between selling it personally and selling it through a limited company. The tax saving and the cash difference is £63,504, plus the tax savings that we're going to make and have made of 112,000 gives you a cash advantage of £175,000. And for all intents and purposes, in a kind of a humble way, this isn't a big development, so that figure is pretty significant. That could have been twice, this development could have been twice that size, i.e. 24 flats, 25 flats, and the savings could have been double. So I think it's a pretty significant tax saving, and I hope it kind of drums home to everybody on this particular call some of the advantages and benefits of tax planning. Got a final slide here, which I'll go through anyway. So if you're not part of our Facebook group, you can join that in Trust Property Tax Experts. I know a few people here are already members. I can see Darren on the call who does engage. Hi Darren, I hope you're okay. I've also got a YouTube channel where I talk through my developments, so you can watch some of those videos. And if you have any questions, you can email me on shaz@aa-accountants.co.uk. So on that note, Claire, I'll stop sharing the screen. I'm happy to take questions.
Brilliant. That was really interesting. Thank you for that. Anyone got any questions for Shaz?
I went through that pretty quickly, so I appreciate people may not have caught every single bit, but I'm happy to kind of answer questions on that presentation or any other questions anybody has.
I have.
Christy, I think Sumi's got one after. Go on.
So you were talking about capital allowances. Simon and I work quite closely in the social and supported housing space, and capital allowances are mentioned a lot. I don't really know that much about them, if I'm quite honest, because that's where you guys come in. But I just wanted to check, you were talking about them, are they netted off throughout the year to provide tax relief, or how do capital allowances work in the whole once you've obtained them?
Yeah, so you use them depending on the type of capital allowance they are in a particular year, and if you don't use them in that year, you then carry them forward and use them over a number of years.
Brilliant. And that's just netted off as like a total tax kind of relief.
Yep.
Is it until you use them up, or is there a set number of years?
No, it's until you use them up, and you can decide how you use them up. So without getting into too much detail to kind of confuse anybody, you can claim a certain amount every year, and then you've got something called an annual investment allowance, which allows you to claim a much bigger figure. And then if you've got energy efficient equipment, you can use that quicker. But just to keep it very simple, you can claim 18% in your general pool. So claiming 18% every year would take you, I think, about 18 or 19 years to claim all in one go. But you don't have to claim that 18% every year, Christy. If you wanted to claim 5% or 7%, you choose how much you want to claim, but you can't go over the 18%. I'm simplifying it, by the way, but yeah.
No, that's fine. And my only other question is there a list anywhere of what you can claim? How a capital allowance is defined, or is that, obviously that's where you come in, we come to you, we say we've got all these things, what can we define as capital allowances?
Yeah, so an expert goes in there, looks at the building and sees what is in the building, which isn't part of the building, but it's fixed to the building. So for example, if you've got cameras there, if you've got aircon units there, that type of stuff, radiators which are fixed to the walls. I do have a list somewhere, and Claire, if you remind me, I'll share a list with you, Christy. It's not an exhaustive list, but hopefully it'll be sufficient to demonstrate to you the kind of things you could claim.
Yeah. Can I just check as well, do intangible assets, so they included like software licenses and stuff like that?
Intangible assets are different to physical capital allowances.
Okay, but you can do those as well?
No.
Okay.
We used to be able to, and you at one point you were able to write off goodwill. Now you can write off some of the goodwill, but it's nowhere near what it used to be. And HMRC or the government are most stringent on the type of goodwill you can and you can't claim.
Fab. No, I think the answer is just to come to you.
Just to cover that point for you a bit more. If you have a patent, then there's something called a patent box claim, which you can make. And any money that you make or any sales you make because of that particular patent, you can get tax relief on that. So although a patent is an intangible asset, you can get extra tax relief for that if that applies to you.
Yeah, I think I'll just come to you if I need something. I'll send our developers your way.
That's what people usually do, Christy. Good call.
Thank you.
You're welcome anytime.
Shaz, is there any way to find out the previous owner claim the capital allowances?
Yeah, so when you make those inquiries, when you're buying the property, you ask them to find out how much they've claimed previously, and then they'll make that disclosure to your solicitor during that conversation.
And wouldn't that, for example, if someone is not aware of the capital allowances, wouldn't that make them think twice about the price for what they're selling the property. For example, in your case, the building was worth 500,000. If they were not aware of the capital allowances, and suddenly someone told.
Yep, that's a good question, and it's a question that I, alongside other obviously tax experts, get asked often. You're right, but if you can appreciate, by the time you're making those inquiries, they've agreed to sell the property. And again, I'm generalizing. Most people are selling a property for a particular reason, and at that time, their mind is made up that they just want to get rid of the property. And again, depending on when you're buying, I mean, right now, if you're buying commercial property, and again, I'm generalizing, but I've just bought one now, where they'd had it on sale for best part of 2 years, and they were too glad to get rid of it and sell it to us. So by the time you get to that stage, most people just want to sell the property, and it's unlikely they will want to renegotiate. I've never come across that situation. I'm not saying it's not possible, but I've not seen it so far.
But also you wouldn't make your numbers based on the capital allowances claim.
No, that's just an extra benefit to
extra,
you.
yeah.
That's
Okay.
right. Yeah.
Thank you.
Absolutely. I think Sumi wants to come in?
Yeah, thank you. Shaz, thank you very much for that presentation. That was really informative, actually. I don't know whether I missed the first part, but I understood that you bought the property in a partnership and then transferred it into a limited. May I ask what were the financial benefits of doing it that way and not starting off straight off the bat with a limited?
So if we bought the property, and thank you for the question, if we bought the property in a limited company, then the purchase price would have been what we paid for it. In this particular instance, obviously £500,000. But because we bought it in a partnership, we then went through a process where we obtained full planning permission and had an uplift in the value. When the property moved into a limited company or into the limited company, the base cost, or for our purposes, let's call it the new purchase price, was £650,000. So when the property moved, the value of the property is based on the day that the property moves from a partnership into a limited company. So we had an increase in the value, which we weren't able to do had we bought it straight into the limited company. I hope that kind of makes sense. Yeah.
Almost. I think so. I might have to listen to that.
There's an uplift in the value, which is recognized in the accounts because we've enhanced the value. Whereas if you buy it in a limited company, even though we apply for planning permission and we increase the value, we can't recognize that as a gain, and we can't write that off for tax purposes.
Okay. Yeah. Thank you.
Ken, do you want to ask your question?
Hi.
Oh, there he is.
Hello there. Hi. Can I ask a question of type that not related to Shaz example?
I can just about hear you, so I'll turn up my speaker volume, but if you can just speak up a bit, Ken, that might be helpful.
Yeah. Can you hear me okay now?
Yep, I can hear you. Yeah, that's better. Thank you.
Basically, if I've got a property company, started last September, but not made any profit or any deals, but obviously I've had running costs and all that kind of thing. When do I need to file in paperwork?
Is this a limited company?
Limited company, yeah.
So if you go onto Companies House, it will show you your year end. So let's say if you started your company on the 15th of September 2020, for example, then your year end would be the 30th of September 2021. Okay, and generally speaking, at the moment there's an exemption from Companies House, but generally speaking, you have to file your accounts 9 months after the year end. So in your case, it would be 9 months after the 30th of September 2021 which would be the 30th of June 2022. Yeah. However, your first set of accounts, Ken, you don't file based on the end of the month of the year end. You have to file it on the day you incorporated. So for your purposes, and using my example, if you incorporated, i.e. started your company on the 15th of September 2020, then you would have to file your first set of accounts by the 15th of June 2022. But for 2023 onwards, you would then have to file the accounts by the 30th of June that year, if that makes sense. Yeah. So the first year, when you file them on the 9 months after the day you incorporated. That kind of makes sense. Yeah. Yeah.
Right. Yep.
That is a bit complicated. I don't know why companies have to do it like that. But so the first year is after your year end, you've got 9 months to file your accounts, but it's not the month end date, which is in your case, it would be the end of June. The first year, it would be the same date as you incorporated, whether it's the 15th, the 10th, the 5th, or whatever. Okay, on that date. All subsequent years, it would be the end of June.
Okay, and I just simply need to find an accountant. You would be able to do this, obviously.
Sorry?
Because I'm new to all this, so basically, I just need to go to find an accountant, and just
Yep. That's right. If you speak to an accountant, they'll be able to file the accounts for you. That's right.
How much would this all cost if say a new startup company made no profit yet? What's the rough cost?
Well, if the company's dormant, which in your case it isn't, it costs you a few £100. But because you've got some expenses running through it, and I assume you've registered to file a corporation tax return with not that much activity. Again, different accountants charge different amounts. So I'll say with no income coming in, anywhere from say £600 to £1,000, depending on who you talk to. Yeah, right. Some more.
Okay.
I doubt you'll find anybody who'll charge less than £600.
Okay. With the filing all the dates all the time, I'll take it that's all. I can quite easily Google that tonight. Actually, when do I need to?
Yes. So if you go on to Company's House, type in the name of your company, the information will be there.
Right.
It'll give you your year-end date, and it will also give you the date when you have to file your next set of accounts.
That's right. Thanks very much.
You're welcome.
Thank you.
Steve, do you want to ask your question?
Thanks, Claire. Hi, Shaz. Thanks for the presentation. Just a quick question, Shaz. I'm just trying to get my head around limited companies. I think I'm not an expert in limited companies, but I also heard recently with some of the joint partners I'm working with, they're talking about limited liability partnerships for commercial properties. In the case study that you showed us, is there any advantages in going down the limited liability partnership route for tax purposes? Especially for inheritance, I was thinking.
Yeah, there can be, Steve. So I think we've got Sue Maxwell on the call as well, Claire. So if that's...
Yes. Hi, Shaz.
Hi, Sue. You right?
Yeah, cool. Thank you. Yeah.
Good. Feel free to jump in at any point, Sue, if you don't agree with me or you have a different perspective. By the way, because
why I am exalted. I wouldn't dream of it. Yes.
No. Feel free, honestly, because sometimes I have other accountants or tax people who have a different opinion or view or want to add something. So I've just seen your name on there. So feel free to jump in at any time that you like. You're welcome, and thank you for being here. So, Steve, an LLP, to keep it again really simple, is basically a partnership with limited liability. So back in the day, people like accountants and lawyers used to, generally speaking, trade as a partnership if there were two or more of them, and especially so for solicitors, they weren't allowed to have limited companies in those days. So if something went wrong, they were personally liable for any particular liquidated damages. So that was a big risk to take. So I think back in 2000 or 2001, limited liability partnerships were introduced, and they weren't just introduced for accountants or lawyers, but from that time onwards, quite a few accountants and lawyers took advantage of that particular structure. So limited liability partnerships are useful. It depends on exactly what you're looking to do. They can work well for certain types of inheritance tax planning. They can also work well for other types of tax planning, but yeah, especially if you're claiming large amounts of capital allowances, but you should work out the figures in terms of what it's going to cost you in tax over, I'd say, at least 5 years. So compare the figures of having a business in an LLP versus having a business in a limited company over 5 years, and that will give you some kind of an indication whether it's better having your business through an LLP or a limited company.
Okay.
But it is a good flexible arrangement, but it doesn't work in every single scenario, but it's worth exploring.
Can I ask one off the back of that, Shaz?
Of course you can, Sue.
Can you incorporate an LLP, or is it already incorporated?
An LLP is a body corporate, so it's already incorporated.
So going back to your benefit on the capital gain that you cleverly rolled in when you incorporated the Working Man's Club, that would not be available had you used an LLP structure, correct?
Yes, because we used a
simple partnership,
standard partnership, just the good old partnership under the 1890 Act, and then we incorporated that. That's right.
Yeah. Okay. I just wanted to bring that forth so that that's an example of when the two are not overlapping, the LLP and the partnership.
Yeah, that's right. So, but without, thank you for that, Sue. But generally, Steve, if you can maybe research a bit about how partnerships work, so you can see the flexibility, and then just think in your own mind. Again, I'm simplifying it, that if you have a partnership running through an LLP, it gives you limited liability. That's the main advantage. There are other things as well which we don't need to go into, but sometimes people like that flexibility. Another example is if you were to run a car which you use personally and you use for business purposes through a limited company, you would have to pay company car tax. If you were to run that same car through an LLP, there's no company car tax to pay per se, because the partners individually own the LLP. So you wouldn't be caught by the benefit in kind tax rules, but you would only be able to claim some of the expenditure for running that car. So that's kind of a general example for you of one of the various benefits of having an LLP.
Thanks, Shaz. Thanks, Sue.
Okay, yeah.
Amgad, do you want to ask your question?
Hi there. Hi, Shaz. Thank you for the presentation. I've got a couple of questions for you. I know you said you've moved the property from a partnership into a limited company. Did you have to pay stamp duty again because now the property has been moved?
And your second question, Amjad?
The second question is if you have properties that you own under your own name, if you wanted to move them to a limited company, is there a way around the stamp duty, or do you still have to pay the stamp duty?
Okay, so to answer the first part of the question, we did not have to pay stamp duty land tax because when a partnership incorporates, you don't have to pay stamp duty land tax when on incorporation. Okay, the second part of your question is it depends. So if you, Amjad, own the properties in your own name and you incorporate, you will have to pay stamp duty land tax. If, however, you and somebody else, i.e. if you have a spouse, husband or wife, and you're civil partners or you're married, and you run a property partnership business, then you may be able to escape paying stamp duty land tax as long as you can demonstrate that you have a property business. Yeah, or sorry, a property partnership business.
Okay, thank you.
But just from your own name into limited company, you'll have to pay the SDLT.
You'll have to pay the, okay. Lovely, thank you, Shaz.
And there again, just for completeness, Shaz, the Ramsey incorporation,
yep,
the LLP won't work.
Yeah, that's right, yes.
Okay, I'm just dotting the I's, thank you. There seems to be a lot of misinformation in other places about that, doesn't there?
Well, different kind of people give you different advice, and then so you've got people who come up with the hybrid structure, yes, where they have a limited company, yep, with an LLP, which works, by the way. It just needs to be done properly. And I think, yes, sometimes certain practitioners make it out to be simpler than it is. It is a complex arrangement which needs to be set up properly. So yes, the answer to add to your point is, if and when you're speaking to a tax expert, to pick up on or to add to Sue's point, is maybe get two or three opinions, just to make sure that you're getting the right advice. But unfortunately, and this applies not just to accountants, it applies to pretty much every single sector, is the more people you ask, the more number of different answers you're going to get. So it's difficult to find two people who pretty much agree on anything and everything, but that's just life in general, I guess. Yeah.
But I think HMRC have deliberately left so they can duck and dive when caught in the tribunal or something, haven't they?
Sorry, I missed the first point there about HMRC have.
Well, they said they've left greyness in the wording of their legislation, so they can almost interpret their own stuff to suit them, can't they?
Yeah, absolutely, and this is why it's important to work with a tax advisor who has a good handle on tax rules, and they can demonstrate to you very clearly which rule they are applying and why they are applying it. And you've got two benefits of doing that. The first one, of course, is it will, if HMRC ever carry out an inquiry, you can demonstrate that you took advice from a qualified practitioner.
Sure.
And what that means is, if you are found to have done something which wasn't right, you can ask for mitigation on the penalties that HMRC may apply, because yes, HMRC can apply up to 100% of the tax as penalties. That's one advantage. The other advantage, which is the main reason, is if a tax advisor or an accountant gives you advice and it's in writing, and it later on is apparent that that advice was incorrect, then you can sue that particular advisor on their professional indemnity insurance. Sure. So having those things in writing as taxpayers and clients will give you some form of comfort if things were to go wrong.
Sure, absolutely. Agree with you there. Thank you.
You're welcome, Sue.
Fantastic. So we've got two good minds. We've got Sue and Shaz sharing their knowledge with us all. I have recorded that, so hopefully that's all okay, everyone, for me to share. It'll only be on the Facebook group. I'm just going to stop the recording.